Retirement doesn't start the day you quit working. It begins the day you start living. It starts when you select how your money will work for you. Many people spend 30 or 40 years generating an income, but only a few years preparing their finances to live without it. Then retirement approaches, and the question becomes awkward. Where is the money coming from now? For some, the answer is savings that gradually evaporate. Others rely on family members. However, for those who planned ahead of time, retirement becomes something entirely different. A period during which money continues to flow even when labor is no longer required. The difference isn't luck, it is preparedness. People who retire comfortably typically adhere to a basic principle. They accumulate various income-producing assets before their working years expire. The following 7 items are worth investing in before retirement, not because they are trendy, but because they have proven to provide long-term financial stability. 1. Dividend-paying stocks. Companies that consistently share profits with investors are among the most trustworthy retirement investments. These are referred to as dividend-paying equities. When you own shares in a steady company, you aren't just expecting a price increase. You also receive a percentage of the company's earnings, which are normally distributed weekly or annually. Over time, these payments can become a reliable source of revenue. Many retirees rely on dividend income to keep their capital invested while earning cash flow. The main takeaway here is simple. Own enterprises, not just money. Businesses continue to create value even when employees are not actively working. 2. Real estate. Real estate has traditionally been seen as a reliable source of long-term prosperity. A well-chosen attribute can fulfill 2 functions. First, its worth may rise with time. Second, it can generate rental money. For retirees, rental income can operate similarly to a monthly paycheck. However, the strength of real estate is not limited to rent. It is also stable. Land and houses are still important, regardless of economic fluctuations. Many people who now enjoy comfortable retirements developed their wealth gradually over time through property ownership that began years ago. The lesson here is that goods that people always require tend to have long-term worth. 3. Retirement accounts and pension plan. Structured retirement plans, often known as pension programs, are often neglected as retirement planning instruments. These plans have a straightforward goal: to amass cash over time and distribute it later in life. Regular contributions along with long investment periods enable compounding to work silently in the background. Small deposits made over time can accumulate into considerable cash reserves. The most important lesson here is patience. Retirement planning rewards those who think in decades rather than months. 4. Index funds. Many investors spend years trying to find the perfect individual stock. Some succeed, many don't. Index funds provide a simpler method. Instead of betting on a single company, an index fund diversifies your investment across multiple companies at once. This decreases risk while allowing for participation in overall market growth. Over time, broad market investments have historically delivered consistent returns. For someone considering retirement, the benefit is obvious: diversification without complexity. The takeaway here is that investing does not always need continuous activity. Consistency can be the most effective tactic in certain situations. 5. Bonds and fixed income investments. While growth investments are crucial, so is stability, especially as retirement approaches. Bonds and other fixed income assets pay predictable interest rates. They are typically less volatile than stocks and can aid in capital preservation during difficult economic times. Many experienced investors gradually raise the proportion of fixed income investments in their portfolios as retirement approaches. The goal is equilibrium. Growth creates riches. Stability protects it. Retirement requires both. 6. Business ownership. Owning or participating in a business is another effective investment before retirement. Unlike traditional employment, a firm can earn money from sources other than the owner's direct labor. Some people start tiny businesses that continue to operate with management or partners even after the founder moves away. Others invest as silent partners in enterprises led by skilled operators. The core premise stays the same. Create systems that generate cash without your constant presence. This can be quite helpful when planning for retirement.
7. Skill and financial knowledge. The final investment may be the most crucial, although it is rarely mentioned on standard investment lists. The investment is knowledge. Every financial decision you make is influenced by your understanding of how money works, including how assets develop, risk operates, and markets behave. A person with good financial awareness can identify possibilities, reject risky schemes, and make better long-term judgments. Financial understanding, more than income level, is often the deciding factor between financial security and financial struggle. Knowledge serves as the foundation for all subsequent investments. Retirement planning isn't about making quick money or discovering the next fashionable item. It is about establishing a structure of dependable income streams far before the need arises. Those who retire comfortably typically do not rely on a single investment. They integrate various things: enterprises, real estate, financial markets, and disciplined saving. Each item has a purpose. Each investment benefits the others. Over time, they combine to produce a formidable financial system that continues to function long after your employment ends. Retirement involves more than just leaving employment. It's about reaching a point in life when your money works harder than you ever did.